Okay, good morning. We are going to finish Chapter 9 today. Right now there is a question in Learning Catalytics out there, and we are going to cover it first. It will stay open for about a minute while I do announcements and things like that, but we're going to talk about it now. The current portion of a long-term debt refers to the amount of interest on a note payable that must be paid in the current year. This is an example of a question where one word makes all the difference in the world for the end answer. And several of the questions we do today hinge on one word. So this question, the current portion of a long-term debt refers to the amount of interest on a note payable that must be paid in the current year. This relates to material we would have done Monday. And actually we're starting with several questions today. So the current portion of a long-term debt refers to the amount of interest on a note payable must be paid in the current year. And again, I'm not closing this question for a little while, but we are going to go over the answer. This is false, and the reason it's false, it all hinges on that one answer, or the one word. And the current portion of long-term debt refers to the amount of principal. For this to be true, it would have to be talking about the amount of principal. The amount of interest is not included in that current portion of long-term debt. As I said, this question will stay open for about, I don't know, a minute or however long it takes me to get through announcements. So if you're just joining us, get on Learning Catalytics very quickly. Some announcements, and then after I'm done with the announcements, that question is going to close because we're starting a new question right after these announcements. Okay, review your exam this week with Haley. That's tomorrow. It's still remaining, 11 a.m. To 2 p.m. That's in room 579 on the 5th floor of the College of Business. That's in the email that I sent out. What's due this Saturday, November 8th? All sections have Chapter 9 homework due. Tonight, we're not going to finish all the homework today, but tonight and early tomorrow morning, I'll post a couple videos on YouTube of the ones we don't go through in class, so those will be available. If you're in Section 3, you also have a quiz this week that will become available by tonight. Okay. Okay, Exam 2 results. The average on the exam was 72.6%. You can see the list of scores. This is the only place you'll see it. The list of scores, you can download the Excel sheet that has all the scores in it at http://tiny.cc/exam02-F2014. I'll pause for a minute. This is also your last warning that that question that's open in Learning Catalytics that we went over in the beginning, it's open. It's going to close after I leave this slide, which will be fairly soon. Again, so if you want to see where your exam score falls, we had several very, very high scores on the exam. Okay, so that first Learning Catalytics question is going to close in just a minute, and now we have a couple other questions coming up fairly rapidly. Again, you can sign into learningcatalytics.com. Okay, next question. All contingent liabilities should be reported on the financial statements, even those that are unlikely to occur. So these questions that we're starting with several of them, relate back to what we did Monday. When we get through these, then we'll go into the new material for today. So all contingent liabilities should be reported on the financial statements, even those that are unlikely to occur. True or false? When we talk about contingent liabilities, we're talking about like the data breach at Target, the potential liabilities it had. We're talking about contingent liabilities are future outcomes based on a past event. Going to close this in 10 seconds. So get your answer in. Again, it's participation based. All contingent liabilities should be reported on the financial statements, even those that are unlikely to occur. That's going to be false. We only report, either put on the balance sheet or disclose, if they're reasonably possible. The frivolous lawsuits don't get disclosed. Companies have frivolous lawsuits filed against them all the time. Okay, next question. All of the following are reported as current liabilities except for bonds payable, sales tax payable, accounts payable, unearned revenues. So which of the following is not a current liability? All of the following are reported as current liabilities except for which one of these? 10 seconds left. And the answer is going to be bonds payable. Now let's think about what the question is, because I know a lot of people got this one wrong. Bonds payable is a long-term liability. That's why typically bonds payable is long-term. Unearned revenues is the other popular answer that it's the popular answer typically. Unearned revenues is a current liability. Unearned revenue represents monies we've collected for goods or services we haven't delivered yet. Mower guy, where he collected $600 at the beginning of the summer for mowing he was going to do, that's unearned revenue. That's a liability until he delivers the goods or services, and that is a short term. So this one, bonds payable, probably a connection issue. Okay, bonds payable. Okay. Now, which of the following liability accounts below is usually not an accrued liability? Interest payable, wages payable, taxes payable, and notes payable. What browser she's using? Like Chrome is a good choice. Leah, Chrome is a really good choice for your browser. That typically has the least. Yeah, Leah, change to Chrome if you can. Maybe you can't do it today, but Chrome's going to probably give you a better experience. Chances are it's recording your answers, but to avoid that, download Chrome in the meantime. Okay, which of the liability accounts below is not usually an accrued liability? About 10 seconds left on this one. Which of the following liability accounts below is not an accrued liability? Now accrued liabilities, just to remind you, an accrued liability is when we've incurred the debt, we owe the money, but we haven't paid it yet. So I haven't closed this yet, but let's think about interest payable. Interest payable arises because we have incurred the interest expense but haven't paid it yet. So the answer can't be A. Wages payable. That happens when payroll cuts off on Friday and we don't actually pay the checks until the following week. That's an accrued liability, so it's not B. Taxes payable. Get to the end of the year and we owe taxes, but we don't pay them until the deadline. That's an accrued liability. We have to recognize we owe the taxes even though we haven't paid it yet. So by process of elimination, we're down to D, and D is going to be the answer because notes payable, we go to the bank, we sign a loan agreement, a note, and they give us cash. Cash has changed hands. Notes payable is not an accrued liability. Interest payable on the note payable is, the notes payable itself is not. So the answer was notes payable. Okay, failure to record an accrued liability causes a company to what? My idea on this one is write down a sample accrual entry, and then if you don't do that, what are you doing? And I'll give you a heads up. Only put one answer in, but there are two correct answers for this question actually. Again, accrued liability is one that we have incurred the debt, we owe it, but we have not paid for it yet. We have not paid cash for it yet. We owe it, cash hasn't changed hands. Okay, so failure to record an accrued liability causes a company to, 10 seconds left on this one. And again, there are two correct answers. You just answer one. And what I did, there's two answers. My first inclination when I answered the first time I did C, but it's also A. To accrue a liability, when we make an accrued entry, when we make an accrual, we're going to be typically debiting an expense, which increases that expense. And we're crediting a liability, which increases the liability. So an accrual entry will typically increase an expense and increase a liability. So if we don't make that entry, our expenses are too low, which means income is too high, overstated. And if we don't make the entry, we don't have that liability on the books, so liabilities are too low and they're understated. So in my example that I'm using here, we have two answers, A and C. C will work in every situation. A will work many times, but C is a better answer, but both of them would be acceptable. And again, when we're talking in class here today, we're participation based. So now on to our new material. So today we're looking at the long-term liability section of the balance sheet. On Monday we did the short-term liabilities. That's where we did the contingent liabilities, the short-term note payable, things like that. Now we're moving down into bonds payable and long-term notes payable. Okay, so and some of this is going to feel familiar, but backwards. We did a chapter a few weeks ago on investments, and we can invest in bonds payable. I used the example of Solar City bonds, solar bonds, where we could go as individuals, we could give Solar City $1,000. and they would give us a bond certificate and pay us interest over the next 1 to 7 years, depending on the term we selected. So that's an investment for us as an individual or anyone that buys those bonds. Now in this chapter, we're doing it from the standpoint of the bond issuer. So this is from the standpoint of SolarCity borrowing the money. So we have to consider, and so some of this is a repeat of what we did in that chapter, but just looking at from the borrower, from the bond issuer standpoint. Bonds are always sold at market price, which is the bond's present value. There are 2 interest rates that set the bond price. And I'm going to say more about the market rate in just a few minutes after people finish writing. We have the stated rate and the market rate. So again, I'm going to wait for most people to finish writing, and then I'm going to talk more about both of those and where they come from. We have 2 interest rates. Whenever we're talking about bonds, there's 2 interest rates. The first one is a stated interest rate, also known as the coupon rate. The coupon rate, or the stated rate, is what the bond pays. When they make up the bonds in the very beginning, when they issue the bonds, they come with a stated rate. They say these are 6% bonds, for example, and that means those bonds are going to pay 6% a year for the life of the bond. It does not change. The company picks that up front. Bonds typically pay interest twice a year, so they pay half the interest for the first half and half the second half of the year. So the stated rate is for a full year. So that is printed on the bond certificate. It's part of the initial issuance, and the stated rate never, ever, ever changes. That's the stated rate. So then we go down to market interest rate. The market interest rate is determined by the nebulous market. The market is made up of bond underwriters, of investors, of brokers, of large institutions, of individuals. Just everyone that's interested in investing in bonds makes up this market rate. Now, very, very sophisticated players in this market. So what they do is they're constantly analyzing what this market rate is. The market rate is what investors demand for a bond of similar characteristics and similar rate. This market rate fluctuates minute to minute. What the Federal Reserve does with interest rates certainly impacts the market rate. What happens in the global world impacts this market rate. And the market rate is continually fluctuating. It's kind of nebulous, but it's there. But that impacts the bond price. So we have the stated rate, which the company controls and they set in the very beginning. And then we have this market rate that's constantly fluctuating. Those 2 things combine to get our bond price. I want to address what's in the chat room because I think some people would be interested in this. I'm going to address it because I'm reading things and it's hard to talk while I'm reading. But anyways, I want to talk about Learning Catalytics for a minute. First of all, you can always review all your class, the questions that we had in class by logging into Learning Catalytics, logging in with your My Accounting Lab ID. Login and password, and you can review any of the sessions. So any of the questions we do in class you can review. You can see what you got credit for, what you didn't get credit for. In My Accounting Lab, all I do is import your score from the day. Your score from the day based on participation, so it's a percentage of questions you answered, not answered right or wrong. When you answer a question, and this is very key, when you answer a question, you put in the answer, you submit it, and your answer will show on the screen for a minute or 2. Watch for that, and then and then your screen will go blank again so it doesn't show. If you want to see later if it went in, or what you answered, you can always go log into Learning Catalytics. By and large, it works very well. If you're in a place where you have sketchy Wi-Fi, there's where a problem is. The other problem I see is when people are changing their answer at the last minute, sometimes that doesn't play well because it interprets that as you didn't answer. So once you answer, just be okay with it. If you're online and you think there's a problem, you need to ask Haley about it. I will look at it. We will investigate it. Sometimes I send it to Learning Catalytics to have them pull the log of what was going on. But by and large, working very well. And so, but we want to hear from you. If you're in class here, wave, or let me know, right after class so we can talk about it. So just so you know, so I was just watching that conversation, so I wanted to interject on that. Okay, so you would have to go back and see the, yeah, okay. Okay, so are the bonds similar to when you purchase a stock in the market? Absolutely, yes it is. Okay, bonds and stocks both have prices quoted in the Wall Street Journal and other places. Okay, bonds are always sold at this market price. The stated rate is always usually different from the market rate. We saw this before, but this is one I would put on my reference sheet. I would absolutely have it because this information can answer lots of questions. The stated interest rate, when our stated interest rate, this coupon rate, what the bond's paying is equal to the market rate, it said that the bond issues at par. Okay? When the stated rate is less than the market rate, the bond's issued at a discount, which makes sense. Market rate's 10%, your bond's paying 6%. No one is going to buy your bond unless you give them a discount. And opposite's true. If your bond's paying 12%, market's paying 8%, you're paying more than the market rate, then you can issue at a premium. People will pay you more. Okay, this slide, and again, I do want to remind you that all the slides are on Blackboard in PowerPoint, the PowerPoint slides, so if you need this to fill in at the last minute or fill in details you don't get, know that you can get it there. This absolutely would be on my sheet, and what we're going to do now is we're going to go through this and go through a couple little examples. But so first thing, okay, so these bond prices. So let's say we have a bond, the quoted price is 100. So the bond prices will typically be quoted at 88, 94, 94.5, 94.875, 100, 102, something like that, clustering around 100. A bond selling at 100. We make the assumption we have a $1,000 face value bond. If it sells at 100, it is sold at $1,000. It's 100% of its face value, and that's said to be selling at par. So in this situation, the market rate is equal to the stated rate, and we say that we sell it at par. So the price of 100 says that this is sold at 100% of its face value. So now the next situation down is 101.5, 101.5. That's the price quote. Well, what that says is this bond is selling at 101.5% of its face value. So the 1,000 times 1.015 gives us $1,015 selling price. Now, because that's more than par, so it's above 100%, we say that that bond is selling at a premium. So that bond has to have a stated rate that's greater than the market rate. A stated rate greater than the market rate is going to lead to a premium. And then we get down to the bottom one. The bottom one, we have 88.375. That says we're going to take $1,000 face value times 88.375%, and we get $883.75. That's our bond price. And that bond is said to be selling at a discount because it's selling less than the face value. So that discount, we sell it at less than it. You would buy a bond at a discount. Again, I think that's too long for your typing. The reason investors buy bonds at a discount is, as an investor, this bond isn't paying as much interest as other bonds, but the company is saying, buy our bond, for example, in this one, buy our bond for $883.75. So at maturity, I get the $1,000. So that discount represents extra interest I'm earning. So the discount gives you extra interest. And that's how this whole system is built. When they're figuring out bond prices, what they're doing is they're making that discount plus the amount of stated interest equal to the market rate effectively is what they're doing. So they're giving you this discount. So the bond price they give you, you get the full face value at maturity. So you make that interest, you just give them less money up front. So that's why you would buy a discount. Okay, so now we're going to go through 5 journal entries. And these are bonds sold at par. These are great journal entries to have, to know these journal entries because they're always going to look the same. And then we're going to do a couple journal entries at bonds sold at a discount so you can see a slight difference. But we're going to go through this example. Okay, so now we have the question, why buy at a premium when you should be losing money? Now, if you buy a bond at a premium, when you buy a bond at a premium, that's telling you that that bond is paying way more interest than the market's paying. So you're getting extra money. So when you pay more, it reduces the interest over time on that bond. So again, you're earning market rate. So when people buy bonds, invest in bonds, every bond is basically set the same. And when I say every bond, considering risk, because different bonds carry different risks. So let's say we're talking about 2 companies with absolutely equal risk. And one pays a lot of a high coupon rate, the other one pays a low coupon rate. Their bond prices are going to be different so that combined with your premium or discount and the stated rate, you are earning exactly the same on both of those bonds. So the only way to make money in the bond market is to bank on what's going to happen to the market rate, and that's why people invest in bonds. Plus, people invest in bonds to have a nice steady income. So they'll say, oh, I'm going to invest in this bond and I'm going to get this much interest every 6 months until the bond matures. I know I have this discount or I know I had to pay a premium, but the market rate is the same for everybody on every bond. They all equal out in terms of choosing a bond. An investor may feel like, oh, this bond's less risk, whatever. So an investor does their own investigation. But the discounts and premiums are meant to equalize the interest rate on every bond within a certain risk category. When we talk about risk, we talk about, let's take 2 companies for example. Let's say we have 2 companies and we have to decide which one's riskier. And we talk about riskier from an investor standpoint. If I'm looking at 2 companies, let's do 2 extremes. So let's say I have Apple stock, which you can debate how far it's going to go, but they certainly aren't going bankrupt next year or anything. So you have Apple stock. Apple issues bonds. And then on the other hand, you have Sony, which is a very old company, very respected company. Sony bonds are extremely risky. The reason they're extremely risky is this year, in 2014, Sony is projected to lose $2.1 billion US dollars. And that's a huge amount. And unless Sony can turn their business around, they may be looking at bankruptcy in the future. As an investor in a bond, I don't want to do, you're going to have to pay me extra money to convince me to invest in Sony because I know they're losing money. I know there's a big question mark over Sony's head. So that's a higher risk category. Sony was downgraded recently to junk bond status, which means they are the highest risk. So now Sony has to pay pretty high rates of interest on their bonds, or their bonds are selling at a very deep discount because people want extra compensation for investing in Sony. Whereas Apple, they're rated pretty high, and so those are two different risk categories. But within the same category, if you had two companies, let's say Google and Amazon in the same, I don't know if they're the same risk category, but if they're in the same risk category, the market rate's going to fluctuate, and when they issue bonds, they are going to have their market prices even it out, so you earn exactly the same interest rate on those bonds between the premium or discount and the interest rate. That's a very long answer, Leah. You probably said you got it a long time ago, sorry. Anyways, okay, so that said, fascinating topic. Now when you look at bonds, if you hear a story about bonds, you can, I know about those. So issuing bonds payable at par. So we're starting with the easiest situation where people buy these bonds at 100% of their face. So in this situation, the bond stated rate, what it pays, is exactly equal to the market rate. So this is our easiest rate. So let's say Southwest Airlines has 50,000 of 9% bonds that mature in 5 years. So they issued bonds at par on January 1st, 2014. Okay, so when we issue the bonds, we're selling them at par. So we're selling them at 50,000. What happens when we issue these bonds? Well, we being Southwest. Southwest issues the bonds. So Southwest, investors pay Southwest $50,000. Southwest gives them bond certificates. So what's going to happen here is Southwest gets an inflection of cash, they increase cash, and they also increase their liabilities at the same time. So Southwest has this increase in cash and this increase in liabilities as well. So that's one journal entry. There's 5 we're going through. So these 5 will get you through most situations with a bond at par. And then we'll show you how it discounts a little bit different. Okay, so that's one. That is issuing bonds payable at par. And that was we issued these bonds on January 1st, 2014, because that becomes important in a couple journal entries from now. So now our next journal entry, same situation, and we're going to have interest expense July 1st. We issue the bonds January 1st. July 1st comes along, we pay the interest. So we pay the interest. First of all, we have to calculate it. Now you can calculate it a couple different ways. It doesn't matter how you calculate it. I'll tell you why I calculate it the way I do. What I'm going to do here is I'm going to take, when we see that 9%, that's for the whole year. But we pay bonds twice a year. So what we're going to do is we're going to take 50,000, the face value, times 9%, which is the full year, times 6 months out of 12. And the reason I use 6 months out of 12 is sometimes we might need to do something for 2 months or for 3 months, and you can just substitute the number of months over 12. Can you take 50,000 times 4.5? Absolutely yes. You can divide that interest rate by 2. In this situation, it's going to work just fine. I was just using a more generic calculation here. So we know our interest on these every 6 months is $2,250. So now we're going to record the first payment. They paid this interest. Well, they paid the interest. They calculated it. So we are going to debit interest expense. Okay, for the $2,250, we're increasing expense. And we're going to credit cash because we're paying out cash. This is July 1st. We're paying it out. Good. Cash goes out the door. Debit interest expense. We're done. So this is an interest payment when there's no accrual involved. Notice that we didn't make any accrual. We're not at the end of the year. So in this case, we just could pay the interest. That's our second journal entry. Now our third one coming up here is now at year end. So year end is December 31st. And this is a big deal. We don't pay the interest till January 1st. So what we need to do on December 31st, we can't just say, oh, let's pay interest early. We're not going to do this. What we have to do on December 31st is we have to do an accrual. An accrual, we have to recognize that we had interest expense. We borrowed that money from July 1st when we paid the interest last till December 31st. That's 6 months of interest. We have to recognize that we have interest expense. In addition, we need to show that we have a liability for that interest we've already incurred. So what we're doing on December 31st, because we don't make the interest payment until January 1st. On bonds, we always deal with full months of interest. We don't split one day here or one day there. So what we're going to do here is we're going to take, we know that the interest from July 1st to December 31st is at $2,250. That hasn't changed. So what we're going to do here is we are going to debit interest expense again because we need to recognize an interest. So it looks much like that journal entry we just did. But we're not paying cash on December 31st. We're accruing a liability. We have a liability, so we're going to have interest payable. So we're going to debit interest expense, credit interest payable, and that's what we're doing to accrue interest on December 31st. We're making the payment on January 1st, but we need to recognize it in this fiscal year because we incurred the interest from July to December. So now we need to recognize that we have interest expense and that we have a liability for that. Our next entry then, so this was December 31st. We were accruing interest. The next entry chronologically is going to be January 1st. So January 1st, we actually cut the interest checks and send them out. So when we do that, we have to say, okay, well we know we're making this payment. Okay, we're paying the interest. We're paying that $2,250. Once we pay it, we don't have the liability anymore. So we can debit the interest payable that we just set up because we don't have. Once we pay it, we're done. And then we're going to credit cash because we're paying cash. We have one more entry. And our next entry, we have to fast forward 5 years. These were 5-year bonds that they issued on January 1st, 2014. So what we're doing now is we're saying, okay, at maturity, so this is 5 years later. We fast forwarded to 5 years from now. We pay off the bonds. So what Southwest does at that point is Southwest says, okay, bondholders, we borrowed your money, now we're paying you back. So they're going to be paying, Southwest is going to be paying out cash, so we'll be crediting cash. And what we're doing on the debt side is we're getting rid of that liability. We don't have that debt anymore once we pay it off. We don't need to worry about the interest on the payment of maturity because interest is done typically as a separate payment stream. So at maturity, you're not going to worry about interest because that gets paid off. The interest payment goes out automatically. So when we pay these bonds at maturity, we want to wipe out the original liability. So when we issued these bonds, we had this liability in our books for $50,000. Now we're paying it off, so we're going to debit the $50,000, and then we're going to credit cash because we're paying it off with cash. So that's what we do at maturity. So those were examples of all the journal entries having to do with when we sell this and when we issue it at par value or at face value. Now we've got just a couple differences, and I'm going to go through the ones at a discount. And then on your homework, I think we have one at a premium or discount. So that's one of the ones I'll record. Okay, so now same kind of scenario, changed a few numbers. Now let's assume discount's the key word here. Now we're going to issue these bonds at a discount. So let's say that Southwest Airlines issued 100,000 of 9% 5-year bonds. Okay, so first of all, 100,000 is the face value of these bonds. 9% is the stated rate or the coupon rate. These bonds pay 9% interest a year or 4.5% every 6 months. And the market interest rate's 10%. So boom, I look at that. Market's paying 10, Southwest is paying 9. For anyone to want to touch Southwest bonds, Southwest's going to have to issue this at a discount. Okay, the market price of the bond drops, and Southwest receives $96,149 at issuance. Okay, so what they're doing there for us is they're telling us what this bond sells for. So they did the math for us. They could have easily said the market price is 96.375 or something like that. They didn't. They just said, here's the market price. So we're given the market price. So what we're going to do when Southwest issues this bond is, first of all, how much cash does Southwest get? Southwest gets the market price, $96,149. Now, I don't have this animated in the order that I wanted as I was thinking about this. Now, what I would do is I would skip one line in your notes and go down to that third line, indent, and what we're going to do is we're going to credit bonds payable, and we'll credit bonds payable for the face amount. Southwest has to pay $100,000 back. Southwest has this liability of $100,000. So I'm going to credit bonds payable for $100,000. So those two numbers are really easy to get. The cash, because we know what we're selling it for, and the bond payable, which is always recorded at the face value. So we have those two values. Now what we can do is take the difference between them. So if I take the $96,149 away from $100,000, I'll get this next line, which is discount on bonds payable. So here's what we end up with. It looks like this. Okay? So we have the cash, which is the market price. We had the bonds payable, the credit to $100,000, that was the face value. The difference between them is the $3,851. That's the discount. That represents extra interest that Southwest is paying the investor, because Southwest only got $96,149, but Southwest at the end of 5 years has to pay the investor back $100,000. So this is like prepaid interest for the investor. So that's a discount on bonds payable. It gets subtracted from the liability on the balance sheet. We'll see that coming up. Okay, so that discount that we talked about, I'm going to call your attention to the lower third. The discount, what happens on the balance sheet with the discount is we see in long-term liabilities, we see the $100,000 face value, subtract the discount. You want to make a note, you would add premiums. Okay? So discounts reduce the liabilities, premiums increase them. Okay, so we said this discount is prepaid interest. And what happens to that discount over the life of the bond is Southwest amortizes it, meaning it reduces it, and it puts it in interest expense over the life of the bond. So what we see next, if you're following along on the PowerPoints, I'm skipping some of them. They're absolutely valid PowerPoints, but some of it we're not getting into. Okay, so that discount of $3,851, it decreases. We allocate it to interest expense. When we allocate it, that's amortizing. We have that word amortize. Amortize is what happens to discounts and premiums. And then I want to emphasize this. We are not covering the effective interest method, and you're not responsible for it. Okay, so now we have that discount, and what we do is we amortize it. We spread it over the life of the bond. Now there's a really neat way to do that so that if the market rate is 10% and your bond's paying 8%, you can amortize it based on the current value, current carrying value each time, so that you have a steady interest rate over the whole life of the bond. That's called an effective interest rate, and that's the effective interest method. If we were going to cover the effective interest method in here, we would take an entire class period, if not more. The effective interest method, really slick, really nice, but it's really beyond the scope of this class in my opinion. So we are not covering the effective interest method. We're going to do straight line. It'll serve the job, serve the purpose. If you're an accounting major, you absolutely will cover effective interest method when you get into corp accounting. If you're a finance major, you'll cover it as well, but we are not going to take a whole class period for effective interest method. So when you see effective interest method, you don't need to know how to do it. On this next slide I have, and if you have the PowerPoints, on that upper third here, there's a spreadsheet. This is how you do the calculations for effective interest method. You would use Excel. There's lots of formulas, lots of calculations. What we're doing right now is we're just going to assume that's given to us. Okay? So when we record interest expense and interest payment for the 6 months, we're going to do a straight line one in a bit. So the only thing you need to worry about on this journal entry is not the numbers, but the fact, and we'll see this later, we're going to debit interest expense, credit discounts on bonds payable, and we might credit cash depending on what's going on. So I just want to say if you have the PowerPoint slides, I always like to think that this is something we want to do, and then I think, no, we don't have enough class period to do it justice. So we're not doing effective interest method. You can do effective interest method with discounts and premiums. We're not doing it. We're doing straight line, which basically says we would take the 3,851, divide by the number of interest payments or the number of years, and then divide it in half for the year. That's all you do. Straight line. Take the whole thing, divide by, if you have 5-year bonds, we're going to take the whole discount, divide by 5 years for the amount of a discount a year, and then you take half of it each 6 months. So that's all we're doing. So again, no effective interest method in this class. Something to note, partial period interest amounts, you adjust for the number of months out of 12. So if you have a situation where you're accruing for 2 months, you take the full interest for the year, multiply by 2/12, and that's why we were back calculating interest where I said multiply by 6/12. Partial year, that's where you adjust. You put the number of months in there. Okay, issuing bonds at a premium, we'll see that later. If you have the slides, you probably should get the slides, the PowerPoint slides. There's a good example of the journal entries for a premium. Premiums get added, not subtracted. Again, that's all there. Straight line amortization method, we just divide it by the number of periods we have. That's it. Okay, so now we're going to do a question. We're going to do a couple questions, right? Okay, questions out there in Learning Catalytics. A bond with a face value of $1,000 and a quoted price of $102 has a selling price of $1,020. True or false? Okay, 10 seconds. A bond with a face value of $1,000 and a quoted price of $102 has a selling price of $1,020. True or false? Okay, and that's true. Okay. One more and then we're going to get into some homework. If the interest rate on a bond is 8% and the market interest rate is 7%, the bond will be issued at a price above the par value of the bond. True or false? So the stated interest rate on the bond is 8% and the market rate is 7%. Okay, if the interest rate on a bond is 8%, and the market interest rate is 7%, the bond will be issued at a price above the par value of the bond. True or false? 10 seconds on this one. Okay, interest rate on a bond is 8%, market rate 7%. That's going to be true. Interest rate on a bond is 8%, so it's paying 8, market 7. People are going to pay a premium because this is paying more than the market rate. Okay, now homework problem, 9-8. This should be a pretty easy review at this point because it's going to be using those journal entries we did, the sample journal entries at the beginning of class. So we have a corporation issued 4% 7-year bonds payable. So when it says 4% bonds, that means they're paying 4% per year. 7-year bonds, they mature in 7 years with a face amount of $150,000 when the market rate was 4%. Okay, so they're paying 4%, market rate's 4%, we're selling at par. Okay, assume that the accounting year ends on December 31st and the bonds pay interest January 1 and July 1. So first thing we're going to do is issue the bonds payable at par July 1. So what we're doing there is we're getting cash, we're issuing them at par, so we're getting cash of $150,000, crediting bonds payable for the $150,000. Okay, so we're getting the cash in, we're crediting bonds payable. The next entry down, accrual of interest expense on December 31st. So we're accruing the interest. So what we're going to see here is we're going to take the 150 face value times the 4% times 6 months out of 12. So we're going to get interest expense of $3,000. That's, remember, interest, when they state the rate, it's for a full year. Here we're only 6 months out of 12. So this is actually setting up to accrue the interest expense. So we're accruing interest expense, we're debiting interest expense, crediting interest payable. Because this is December 31st, we've held the bonds for 6 months. We're not paying the interest until January 1. So this is why we're accruing for it. We want to recognize that we have the expense and we have the related liability. Next one down. So we accrue for it here. We're in this entry. We're saying this is December 31st. We know we have to make this payment, so we're going to debit the interest expense. So we get the interest in the right year, the part that where we borrowed the money, but we have a liability. So on January 1, when we pay that liability off, we want to wipe it out. So what we're going to do for C, payment of the cash interest, is we're going to start by wiping out that liability. So we're going to debit interest payable, and we're going to credit cash because we're paying the interest in cash. And then entry D, what we're doing there is we're fast forwarding. We're fast forwarding 7 years into the future because we have to pay the bonds at maturity. So these mature bonds at maturity. The issuing corporation has to pay the investor the face value of the bonds. So what we're going to do in entry D is we're going to wipe out the liabilities. Once they pay the investors off, we don't have that bond payable anymore, and the amount is for the face value. We don't have to do anything with interest because the interest payment is a separate entry. It's done independently of maturity. Okay, so that's exercise 9-8. There's another bond exercise. I'll record a step-by-step how-to on that one. And what we're going to do right now, another question's coming out to you. True-false question. Purchasing merchandise inventory on account results in a liability. True or false? Okay, well, we just switched it. Huh. I know. We're just answer the one you have. We crossed wires up here. Where is it? Okay, I'm gonna find it. It's not. App share. You're gonna have to. Yeah, you're going to have to app share because I don't know where they are now. Okay, so the question that should have been up is a current liability must be paid out of current profits. We're going to see that other one coming up. Yeah, I did that. That'll work. Okay, current liability must be paid out of current profits. True or false? Another 10 seconds. Okay, and this one will be false. The reason it's false is because, okay, when we pay a current liability, we pay liabilities with cash. Profit is a nebulous term. It doesn't represent cash. We pay liabilities out of current assets, not out of profits. So that's why that one is false. Okay, and now we talk a little bit more about putting this into perspective, looking at financing, how we can finance. There are 3 ways to finance growth or to finance projects. The first one is through retained earnings, and this is where companies are profitable and they've got enough cash from operations. This is low risk. This is what every company would dream of doing. Just let's go from growth, but oftentimes growth isn't enough to finance operations. So then it leaves you with 2 options. You can add, this is the company that's looking to expand. How do we finance things, finance operations? We can issue equity. Okay, so this is the company issuing stock. So we're giving out shareholder certificates, and this creates no liabilities, no interest expense, and this is considered to be less risky. And when we talk about less risky, we're talking about from the corporation that's issuing the stock. If we issue stock, we don't ever have to pay our shareholders anything. Okay? We don't have any required interest expense. We don't have any required cash payments. But on the other hand, issuing equity is considered the most expensive form of financing operations because we have to give up control of some control of the organization. We have to ultimately, we're going to have to reward shareholders or they're going to vote us out of office. So this idea that issuing equity and stock, it is the most expensive even though it's the least risky for the corporation. And then finally we have issuing bonds payable or notes payable. This does not dilute control, meaning we don't give any ownership up. If we as a company issue bonds, we are not giving up ownership. We are simply saying we'll pay you back. The bonds issues increases risk. The reason we say it increases risk is because when we issue a bond, we are required to pay interest on that bond according to terms. So whether we have a lean year or a really good year, we still have to pay the interest. Shareholders, if we have a bad year, we can say to shareholders, we're not paying any dividends and we're not breaking any laws. But if we try to do that with interest, we can be hauled in, we can go bankrupt not paying our interest. So debt is considered more risky for a corporation because they have to pay the interest. But equity is considered to be more costly because you're giving up control and you're giving up ownership and you're going to have to reward those shareholders some way. So those are kind of our three options for financing financing operations. Okay, so what we're going to do now is we're going to do a homework problem. Just to note that long-term debt is reported on our balance sheet at fair value. Okay, fair value is if we have publicly trading debt, if we issue bonds and they're publicly traded, we report them on the balance sheet at the market prices. Okay, with that we go into short exercise 915. This is a kind of nice little exercise. This is saying how do we report these things? What does the liability section of our balance sheet look like? So what we're given is we're given that green table there, and that table has a whole bunch of accounts listed. They are not listed in any order, nor are they guaranteed to be in the liability section of our balance sheet. So what we're doing in this exercise is we're creating the liability section of the balance sheet only. So what we have to do basically, it also tells us in the last sentence that it wants us to list current liabilities and total liabilities. So we have to separate. So the first thing I would do here is I would make a note of current and long-term. We're going to go through and we're looking for just the liability section of the balance sheet. So we're going to go through this list and we're going to identify first of all if something's current liability, and then we're going to go through and find the long-term, and then we'll put it all together. So current liabilities, let's start with the top. Bonds payable excluding current portions. That doesn't sound like a current liability, so we can ignore that one. We're not going to, that's not part of current. Equipment. Yeah, equipment is an asset, so we're not going to include that either. Current portion of bonds payable. Well, that sounds like it, so we're going to have current portion of long-term bonds payable. So good, so we've got one thing. Next thing down, note payable long-term. That's not going to be a current one. Interest payable, due March 1st, 2015. That is a current liability because our balance sheet date is December 31st, 2014. Current means within a year, so this would be within a year. Accounts payable is always going to be a current liability. Discount on bonds payable, all long-term. So that's not current because it tells us it's long-term. Accounts receivable. Accounts receivable is an asset. It's what we're due from our customers, so it's not even on the liability section. So what I've circled right there, those three accounts, those are current in our current liabilities. Now going on with long-term. So now going back up to the top of the list, looking at the things we did select to see if they're long-term. Bonds payable. That would be a long-term liability. Equipment we can skip again because it is an asset. Notes payable long-term, that's going to be a long-term liability. Discount on bonds payable, that is absolutely a long-term liability. It tells us all long-term. And then we can ignore accounts receivable because accounts receivable, again, is an asset. So that's where I'm getting the numbers. And what we're going to see now is I'm just going to kind of put it up here. Current liabilities. So we're going to list those current liabilities. Things to note. Accounts payable is always listed first, virtually always. So you're going to see accounts payable first, and then the other one's the current portion and the interest payable. And we're going to have a total for current liabilities. Now, down to long-term, can you move? Yeah. Okay, long-term, we have notes payable, that's good. Now bonds payable, notice the discount on bonds payable is subtracted. It doesn't show in the chart as negative, but we as sophisticated users of financial statements know that discounts are subtracted. A premium would be added. Okay, so discounts and premiums behave backwards. But discount on bonds payable is subtracted, and our total liabilities are those 6 accounts. But remembering that discounts get subtracted. Okay, we're going to do a couple more Learning Catalytics questions. I think we're going to start with the one that I wanted to do last time. Okay. So we're pushing out another question. This one, purchasing merchandise inventory on account results in a liability, true or false? So that question is out on Learning Catalytics right now. Okay. Purchasing merchandise inventory on account results in a liability, true or false? Okay. Okay, purchasing merchandise inventory on account results in a liability. You have about 10 seconds to answer this one. We do have another one coming up, or two, I don't remember. Okay, purchasing merchandise inventory on account results in a liability. That one is true. We purchase merchandise inventory on account. We're going to debit inventory and credit accounts payable. Okay, and then we have another one. And this next one that you see, we started, it was near the beginning of class, so you did see it before. I want to see if we can improve the score on it. So this next one coming up. All of the following are reported as current liabilities except, is it bonds payable, sales tax payable, accounts payable, or unearned revenues? Okay, that's, don't close it. Okay, but the answer, make sure you get your answer in. If you know it, you're free to leave. We're going to close it in 20 seconds, so get your answer in. Pretty good. Okay, and the answer is bonds payable. It's typically a long-term liability.